Well, these days the RBA cash rate target is less important than the other things it does that flood the banking system with cash. What actually determines the rates for mortgages and business loans is the bank bill swap rate, or BBSW. Now, it's usually above the RBA rate, as it was in February, but currently it's only 0.1%, down from 0.9% back then. So, during the pandemic, the RBA is getting as much interest rate bang from the bucks it's printing as from its rate cuts, which stopped at 0.25%. Meanwhile, the dollar seems destined to hit 75 US cents before long, which is definitely not what the RBA wants. Today's lurch above 74 was due to a record current account surplus, which wasn't actually good news. It was due to a big jump in the services trade balance, in turn caused not by a rise in exports, but a collapse in services imports, basically tourism and education, which halved while exports fell 20%. The market consensus forecast for tomorrow's June quarter GDP has it falling 6%. Normally, minus 0.6% would be considered terrible. House prices for August came out today, and while the rest of the country is picking up, Melbourne is not. It's down 1.2% for the month, while other capital cities are down less than last month. And prices in regional cities are actually rising. And that also goes for Adelaide, Perth, Hobart, Darwin and Canberra, all either steady or higher. Here's the chart of Melbourne versus Sydney, and you can see the big gap that's opening up between them now. The share market fell quite a lot today, and one of the biggest falls was QBE, down 6.3%, as CEO Pat Regan sadly carried his cardboard box out the door. And apart from that, it was a sea of red. Nasdaq went up last night because Tesla jumped 12% after a 5-for-1 share split, and iron ore and gold both rose on commodity markets. And that's finance.